So let's bring in Lauren Goodwin of New York Life Investments and Marci McGregor of Merrill and Bank of America Private Bank. Ladies, it's great to see you. Lauren, thanks for being here on set. That's what this is about, right? I mean, we just get we're only going to be able to stand so many of these hotter than expected inflation reads, right?
I have a slightly different take on it. I think that the market can withstand hotter inflation as long as a couple things are true. First is that the reason we're seeing this backup in rates and tightening in financial conditions is in part because growth is good, right? Earnings results are good. That's supportive for the market. The second reason I think this is a Fed that, though they are not able to cut right now, the data is not allowing that, they're eager to cut. And so I expect actually we'll see a less hawkish than expected Fed tomorrow.
Wow, I hear a new tone from Lauren Goodwin. Are you more positive on the market now than you've been in a while?
I'm positive on the market. I'm still.
Yeah, come on now. You've been pretty cautious for a while, okay? Right? I mean, you have been. I hear somebody who's suggesting that this market, this rally, can resume.
That's right. I think that's the case. Now, the challenge is that the uptick in growth that we're seeing, it's on the verge of overheating, right? And that's always been the top risk from my perspective to financial conditions, to this economy. And so it's not something that makes me think we get to then avoid a recession, but it's not here right now. And so I don't see any reason to dwell on it. I don't think it's the right thing to do.
Okay. How about you, Marci?
Well, I mean, I think the market has been having this tug of war between inflation concerns, stagflation fears, and earnings, right, which have been better than expected. And our view is that trend continues for the balance of the year. I don't think the last 5 months of this rally was just Fed enthusiasm, right? Because we've seen better than expected earnings. We now are on the verge of our third quarter of positive year-over-year EPS growth. And I think that's the fundamental anchor to this market. So yes, all eyes will be on the Fed. When the Fed tells us they're data dependent, the market hangs on every data point. And of course, this last mile of inflation has proved stickier than Powell would like. But I think you're going to hear Powell tomorrow kind of reiterate that policy needs time to take effect. Our view is you get your first cut later this year, and the market continues to watch every data point. But I think this rally, after a little bit of this April digestion period, resumes based on strong fundamentals, primarily earnings.
Lauren, you think this is just the market trying to get ahead of what is expected to be a more hawkish chair?
I think that what we've seen in the last couple months really is a change in a market fundamental, which is when the Fed can ease off of the plateau, but really hiking cycle that it's been on. And I think it's a very important market fundamental. Marci's right to point out a bit of the tug of war between earnings and backup in financial conditions. But the reality is, from my perspective, that earnings and the labor market are the two things that matter most for the market, because those are the two economic indicators, market indicators that tell us that we're not yet in recession. When those flip and we're already in recession, then I'm worried about the rally, but we're not there on either of those indicators.
Okay, but can we put back up Lauren's key points? Because the one at the top is the one that really sticks out to me. Whether Powell is going to be more hawkish or not tomorrow, you suggest that maybe the market is overdoing it on the worries that he's going to be super hawkish. There you go. Goodwin on the Fed. Powell may not be as hawkish tomorrow as markets fear. What makes you believe that, just given what the inflation reads of late have been?
Well, inflation is telling us that the Fed can't cut now. And frankly, even in January, when the market was expecting cuts to start in March, our view was that the data was telling us the Fed can't cut now. The difference in the past several weeks has been that because the market has caught up to this idea that the data just really isn't showing us what the Fed needs, market financial conditions have tightened. That's already doing some of the Fed's work for it. And I think that Chair Powell is going to say, look, progress on disinflation has stalled, but we are seeing these tightening financial market conditions. They use the same idea in reverse in the fall to avoid having to hike further. I think they'll use it this time to give some calm to the market tomorrow.
Marci, where do I best want to be right now, just given this changing dynamic of further pushed out rate cuts? Maybe inflation is going to just remain stickier than we thought for a while. I could say, hey, growth is going to be pretty good. Earnings are going to be pretty good. But in the whole backdrop, what does that mean?
Look at this market. The market's not panicking. The VIX is down about 30% from the peak a couple of weeks ago. It's really subdued. This is a market that I think wants to refocus. Our view, so we are slightly overweight equities, driven by U.S. equities. I would use weakness as an opportunity to reposition if you have cash to put to work. And I think the big story, if we look ahead later in this year, is going to be one of rotation and a broadening of this market. So I would put money to work probably, I still like tech. I still like, the trends in artificial intelligence. Clearly, this earnings season is all about AI spend and CapEx. But I would also put money to work in the other 493. Energy, quietly a really strong sector, still has a lot of momentum. I like defense stocks. They've underperformed the S&P. We are unfortunately in a world with rising global defense spending. The geopolitics are just red hot. I like healthcare and I like consumer discretionary from here. So I would tilt up in quality for now. But I think earnings broadening out is going to be the key story for investors in the balance of this year.